Welcome to the Techno Fundamental Report for March 26th. Man is not worried by real problems so much as by his imagined anxieties about real problems. Epictetus. Warren Buffett. It's good to learn from your mistakes. It's better to learn from other people's mistakes. That's a very good one. I've learned from a lot of good people, but I've also seen a lot of people make mistakes. Most successful investors, in fact, do nothing but most of the time. Jim Rogers. The ability to do nothing is one of the most underappreciated skills in investing. Morgan House. Sometimes you have to realize, as a good investor, a great investor, it's not always wise to be in the market all the time. Now, speaking of a very difficult period, was 1929. Calvin Coolidge was president going into Herbert Hoover. But how did the 1920s do? Well, pretty good. This is a graph showing the number of radios that were owned. And then this is the 1920s GDP. So you can see up until 1930 and 1929, things were going quite well. The thing that was interesting about Coolidge that I got out of the book, and this is a good book, by the way, I'd recommend it highly, was that he was very motivated by reducing government spending and reducing taxes. So maybe that's a good formula for a booming economy. Now, the problem is you have boom and then you have bust. You have to understand both. Vanguard Capital Markets are estimating that over the long run, their annualized returns are not going to be very high over the next 10 years. But guess what? I don't really think they know. I don't think anybody knows. I certainly don't know. But one thing I do know that's a fact is that if you go through time, you're going to see bull markets and then you're going to see stagnation. Bull markets, then stagnation. So the problem here with, say, index investing or broad mutual fund type investing is that they work great during periods like this. But during periods like this, I actually started in the business right in here. And the only thing that was working was finding growth stocks like Walmart, Home Depot, Microsoft, etc. It's called focus investing because this is the worst case scenario. And I think you should assume that. Now let's talk about fear of missing out. Everyone's concerned about the market dropping. It's been a very difficult market actually for about 6 months now. And so where will the turn be? Well, William O'Neill of Investors Business Daily developed a strategy called the follow-through day. And it makes a lot of sense. But realize not all follow-through days are going to work. Some of them do, though, and that's the beginning of a major cycle. So the message here is you don't plunge in. You move slowly. So for example, this goes back to 2025. This was the tariff scare. The market made a low. Then we had a rally, an attempted rally. The attempted rally. You have to go 4 days now for a follow-through day. So to remind you here, higher close on day one of attempted rally attempt. Okay, that's right here. Followed by 2 days while the index does not fall below the low of the first day. So day one, day two, we did not fall below the low. On day 4 or later, a significant gain in price and volume confirms the follow-through day. So you can see here 1, 2, and then it starts to somewhat fail in day 3, day 4. Tries to do somewhat of a follow-through day, but then fails again. But then you got the volume confirmation, and you got the follow-through day, and we were off to the races with a nice bull cycle. So if we also look at another indicator, is you're coming off the low of the market. You want to look for stocks that are exhibiting strength. So here's Apple Computer. This is 2008, 2009. So I start in June of 2008 and I go to June of 2009. Now, as remember the financial crisis, everything, including Apple, tanked dramatically. Then started to consolidate. Now, this was a long period of time. I mean, this was an experience a lot longer than most people could handle. But then if you look for that breakout of a follow-through day along with the market, but at the same time, I'm mentioning here something at the top here, which is called relative strength. So what I'm doing is I'm dividing the price of Apple stock by the price of the S&P 500. And when Apple broke out and started outperforming the market, that would have really been a signal that Apple was going to be the new leadership. Now, if we remember that this particular market difficulties, now recently in a video a couple of weeks ago, I talked about 6 to 7 fundamental factors that were causing the market to have headaches. But one of the factors was the overbuild of artificial intelligence. Now, back in the third, fourth quarter of 2025, Michael Burry came out and went short on NVIDIA. Well, I actually bought puts, which is basically the same concept. But this is where this all started. So you see here, this is NVIDIA. It made a top in October of 25 and has continued to make a downtrend ever since. In fact, we recently, well, here we made a new low, but we're definitely challenging that low here. So if you also look at Palantir, you can see this is where Michael Burry went negative on Palantir. Now, he was talking about the accounting for, in the case of NVIDIA, was the accounting for the depreciation schedule for their products, which, was definitely controversial. But Palantir here, he also mentions, which is software, and software is having a tough time overall, including Microsoft. But you can see ever since Burry went negative on the stock, it has been in a downtrend. So you have to then ask the question, is the current market situation we're dealing with more to do with AI and overbuilding, or is it something else? Well, we'll just have to see. Now, when it comes to the follow-through day, I'm going to use the QQQs because you can see volume intraday, whereas with my other charts on just the NASDAQ, you can't. But so here we have the follow-through day setup. Now, we made a low last Friday, and we're attempting to rally. Now, we didn't cross below that low, so we're still on count. So we're in day 1, 2, and 3. So the fourth day of the follow-through day will be tomorrow, which is Thursday, the 26th. So if we get a major blast off of, say, more than 1% move in the market, that will be a follow-through day. Now, here's the S&P. Now, I'm using the SPY, which is an ETF representing the S&P 500. I can get volume intraday. And you can see here we made the low. Now we've got the first day, second day. Now we're in the third day. If we can get to tomorrow and get a meaningful move, that could be a follow-through day. And basically you just nibble. You don't plunge. Now on the aggression index, I decided to look at it a different way. We're going to look at 5 aggression indexes that I've developed here. The old standby has been the NASDAQ divided by the low volatility ETF, but also the other indicator was the NASDAQ divided by consumer staples. But we'll start with this one. Now, the rule is we want to be above the lower moving average and the lower moving average turn up. Well, in this case, the lower moving average looks somewhat flat, so I would say that's no. Here we have the next one, which is the NASDAQ divided by the consumer staples. Again, you can see we're above the lower moving average. Lower moving average has turned up, so I say yes on that one. Now we're going to use some ETFs in this calculation as well. What we want is 3 out of these 5. We have 5 of these aggression indexes, we want 3 out of 5 to get pretty bullish. Well, we're not even above the lower moving average on the ARK fund, which is an aggressive growth fund. We're not even above the lower moving average, so that's a no. So we only have one so far. This is the IBD 50 fund. This is a index or an ETF, basically, of 50 growth stocks that Investors Business Daily follows. Not above the lower moving average, way above it. Lots of white space, so that's definitely a no. And this is the Momentum Shares, which is another ETF that tracks USA momentum stocks. You can see it is bumping up against the lower moving average, but the lower moving average is definitely turned down. So overall, I'm saying that the aggression index is continuing to stay defensive. Now here is interest rates. Interest rates are kind of perking up a little bit here. We're seeing an increase. This is the 5-year Treasury approaching 4%. We're above 0 on the power index. So interest rates for the 5-year Treasury have climbed almost 7% over the last 125 trading days. So interest rates are not going our way as well. So overall, the weight of the evidence is to continue to do nothing, just sit tight and wait for the setup, meaning that we want to see an improved, well, we get a follow-through day, and we also want to see an approved aggression index calculation. If you have any questions, please let me know. Thank you very much.